This week on Bullshift, the podcast, a case study on what an advisor can do to help a client get through a tough situation when the stock market fails. What exactly can a financial advisor do to help you to change your behavior to have a better outcome in a situation like the global financial crisis? Welcome to Bullshift, the podcast. This is the podcast that talks about behavioral finance and how the financial services industry shifts your attention to make you feel more bullish. My name is John DeGuy. I'm the host of the podcast, and I'm also the author of the book, Bullshift. My guest this week is the same as the guest we had last week because we have so much information to go through. That's Colleen Jaconetti. She is the Senior Manager in the Investment Advisory Center with Vanguard in the United States. She has more than 25 years experience in the financial services industry. She has an MBA from Lehigh University, and she's both a CPA and a CFP. Colleen, welcome once again.
Thanks, John. So happy to be here.
It's as though we just spoke. It's just amazing just being able to have these conversations. Last week we talked about all the research that's done by Vanguard with regard to the so-called concept of advisors alpha and what advisors do to add value with their clients. And Vanguard has done some research over this about this topic for a number of years, and over the past 10 or 15 years, they've been refining it and trying to actually quantify it and disaggregate it into various components in terms of, which activities add the most value and why. So I'm wondering if we could this week talk maybe a little more tangibly about behavioral coaching. We've talked about it as being the sort of thing that advises to add value. And certainly, what I talk about, the industry shifting your attention to make you feel bullish, is both I both like and dislike the behavioral coaching because I think it works, let's call it 19 times out of 20, but I do worry that sometimes optimism bias gets in the way and people get carried away and don't really consider the risks they're taking. As a result of that, can you perhaps give me an example of what you mean by adding value through behavioral coaching?
Yeah, I'd be happy to. The global financial crisis really provides an excellent opportunity, right, to think about behavioral coaching. If you kind of think back to, I guess I should start with, this is a cherry picking example, but sure. If we started at January 1, 2007, with a 50% stock, 50% bond investor, right? And if they invested from then all the way through the end of last year, so the end of 2023, right? And they rebalanced throughout, then their return over this entire portfolio would have been 188%, right? If instead that investor called their advisor, right? Say the market bottom, that's why hence the cherry picking, right? This is the worst case scenario, but at the market bottom, so March 9th, 2009, and so they were really concerned about what's going on in the markets, right? They were not comfortable being invested 50-50 anymore, and they wanted to shift to a 100% bond portfolio. Now, again, this is a very long time period. There would have been plenty of other opportunities so that people would have gotten back in the market. But just for this sake of argument here, we're saying from March 9, 2009 through the end of 2023, right? That portfolio in 100% bonds would have only been up 8%. So what we're talking is 188% for 50-50 if you stayed invested and rebalanced, or if you moved to 100% bonds at the market bottom, you were up 8%, right? So that's a significant amount of wealth creation or destruction, however you want to look at it. Obviously, an investor could have gotten back in, so prior to that, so it could have not have been as drastic. So, I'll take that off the table. But then also, if that same investor, instead of going to bonds, went to 100% cash, they would still be down by 18%. So they have a negative 18% return over this whole time period. So this is a significant amount of value that advisors can create for their clients, right? And just helping them to understand that things happen in the market, unless something significant has changed in their time horizon, risk tolerance, or goals, right? Then they really shouldn't be making decisions based on short-term performance. And that's really what behavioral coaching is. It says we had a plan. Right. Did something fundamentally change with the plan? If not, we should probably stick to the plan.
Right. So that's a great example. Thank you. And it is admittedly cherry picking. Let me offer my thoughts about what my experience was during the global financial crisis. Every client has a set investment policy statement. Every client has a set asset allocation. Let's use 60-40 as an example because that's a fairly standard situation. A lot of those clients, the stock portion may have been down by about half. So if you've got $1 million, it's 600,000 in stocks and 400,000 in bonds. The 600,000 becomes 300,000. Now you've only got 700,000 invested, and you've actually got more money in bonds than you have in stocks. So Financial Planning 101, Portfolio Rebalancing 101 says what we should do is we should take $120,000 out of our bonds to take it from 400 down to 280 and put it into stocks to take it from 300 up to 420. So we're back to our target asset allocation. That was what I was trying to do with my clients. Out of, at the time, maybe 100 families, I got, I'm going to say maybe two families to actively rebalance back to their target. And that was, here's a fun story for me, Colleen. That's what caused me to want to become a portfolio manager. Because even though I tried to coach my clients to do what was right, I couldn't get them to do it. But if I had discretion and I knew I could do the right thing on their behalf without having to get them to say, let's do it, we'll do it that way. Now, I also had two clients that said, you know what, you're right, I just can't handle the risk. Let's dial down the asset allocation. So let's take it from 60-40 down to 50-50 or whatever. So we had that as well. But the very large majority of clients didn't change their asset allocation, but didn't rebalance either. And I tried. And so now, you know, it's now very obvious. Like, look, your asset allocation is out of whack with what's actually in your portfolio. Unless you're going to give me new money to invest, you know, in that asset class that's low, we're going to look offside. And it's funny how compliance departments give advisors a lot of leeway when they try to actively engage in behavioral coaching, and the client refuses to be coached.
Yeah, I mean, I agree. I think that's a really hard spot to be in, right? So I think it's only in hindsight that you know whether it was a good or bad decision to rebalance or not, right? So, you know, and understanding that people's money is very personal. I think there's anything more personal than people's money. But in theory, that's kind of why discretionary relationship is a little bit better from the perspective of you're paying an advisor to be that coach for you and to do this for you because you don't want to have to do it yourself, right? So it's kind of like you're transferring that. And as long as you agree on the risk and return. So like some people, okay, maybe they were in a more aggressive allocation. They shouldn't have been there. But for most people, it's saying, I just know that I'm not going to be able to rebalance or, you know, kind of, I'm going to have a urge to exit the market if things aren't going well. And I need to hand this responsibility to someone else to at least be what we would call an emotional circuit breaker for clients. There's only so much you can do. At the end of the day, it's their decision and their money. And the one thing you could do, like we have a market hindsight tool that kind of produces the analysis that I gave to us on the website. So it's just walking them through those types of examples of, we don't know what's going to happen going forward. And we can't promise that in 6 months or 1 year or 2 years, they'll be back whole or anything like that. But you could show them over various time horizons and a lot of different situations. You know, the equity risk premium is still a thing and you get compensated for taking more risk. And you would hopefully, you know, be in a better position 5, 10, 20 years down the road by rebalancing. But I agree with you. It is unfortunate if you're trying to help people and they may be hesitant to want to go along.
It's funny because a firm that I was at going back to the mid 1990s, we would actively do things that we called lifeboat drills. It was right around the time when the movie Titanic came out. And we would do exactly what you just said. We would show people, you know, here's your asset allocation. Here's the worst that could happen. Here's the likelihood of how much you would draw down. And here's also the likelihood of how long it'll take you to recover your high from before the iceberg hitting. Will you be able to get yourself into the lifeboat and get yourself into safety and stay the course and you know, and stay invested for whatever it is, 3, 4, 5 years, just to get back to where you started before this all happened. And it's important, I think, to my mind, if you're going to be a behavioral coach, to get buy-in from the client, to get them to say, yes, I understand that this is what could happen, and I understand this is the risk that I'm taking as a result of this asset mix, and I am determined to stick to it despite hell or high water, despite whatever the future may or may not hold. the concern that I have, and I expressed this last time too, is that a lot of people, I don't think, really know how much they can handle. And what you said that I love, and I've used the phrase myself, is the best portfolio is one you can stick with. And it can't stick with it, then all the behavioral coaching in the world is not going to do you a whole lot of good, because you were probably in the wrong portfolio to begin with. And
well, this is the shift, right? Like how people come up with the asset allocation maybe should be more along the lines of the drill that you did, right? It's kind of give people the worst case, but not the worst case in a percentage base, in dollars. Saying, if you said you need $2 million to retire, and we're in an 80-20 allocation, and you could lose 30%, what would that do to your retirement plans, right? So like, let's just be real out there. Even if it was $1 million,
$240,000. Yeah.
Right. So are you comfortable with that? Can you sleep at night? Are you in a position where you could actually work longer to make that back up, because you need to get back to there before you can retire? So to me, that is the conversation.
It's 240 on 1 million. It's actually 480 on 2 million. Yeah.
Right. So it's one of those things where that's a significant amount of money. And there has to be an understanding of, while it would be great to earn 5, 6, 7, 9%, right, in the equity market or whatever, it could be obviously a lot higher. You have to understand the downside, and then take it to dollars, and then impact on goal, right? And I think once you get to impact on goal of, oh, you mean I would have $5,000 less a year to spend, or I'd have to work for 3 more years or something else, right? Then I think it hits home to people of, wait, that might be a little too much risk. Let's pare it back.
Right.
So spending more time up front would be really great.
So what's interesting is we've spent some time now talking about sort of worst case scenarios, because it's the most dramatic way of driving home the point about behavioral coaching. I'm wondering if you could maybe talk a little bit more about hacks that advisors could use to proactively get people to buy into doing things and to behaving in a more efficacious manner, in a way that is more in their own long-term interests, to get them to buy in in advance. What sorts of things do you think advisors can do to actually help make things help themselves?
Yeah, I mean, I think the biggest thing is showing clients the wealth creation or destruction that could happen as a result of decisions that they've called in about, right? So it's kind of like going through that example that we just shared, that we talked about with the financial crisis, or really like the market hindsight tool we have. It could be any period of time of, if we had done something else, we call these alternate histories, right? All of these things could have happened. You could have been stayed 50-50, gone 100% bonds or 100% cash. Document those conversations, right? So a lot of people, document when they had the conversations, and then kind of do a look back at maybe an annual look back, or, semi-annual look back of like, hey, if we had done some of the things that you had talked about, this is the amount of wealth creation or destruction that would have happened. And I think why it's important is clients need to understand the value you're providing. This does take time for advisors, right? And it builds trust, but it also has to be communicated. This doesn't show up on a statement, right? The statement only shows the path that you took. It doesn't show the things that you talked about and that didn't happen, good or bad, right? But I think the most important thing is to be honest and transparent with my clients, but that requires advisors to document it and then actually bring it up again in a future conversation with them.
And again, as I mentioned last time as well, the absence of counterfactuals, like you can even get people to do the right thing, but absent a quantified, this is what would have happened had we done what you wanted to do, Mr. Client, you don't really see how the benefit plays out, because all you see is what you see on the statement. And it's funny because people tend to look at things in absolutes. Like, if you can have a portfolio that only loses 2% when all your neighbors are losing 12%, that's a huge value add net. But a lot of people don't see that as a value add, because market went, I lost money. What are you doing telling me you added value? But it's all relative, as the saying goes.
And that's kind of where the articulation comes in, right? So it's one thing to define the value, but then that has to go over to articulation, right? So you're going to define it. Then you have to figure out what's the relative cost, right? How much better off are your clients as a result of the value that you're adding, and then communicating that with clients, right? So it is not a small thing. So I think I say it as if it's like, hey, just define and quantify and articulate your value. We've worked on it for 25 years. It's kind of a big thing, right? So it's not just something that we just assume that it's very easy to do. And that's really why because advisors wanted to know those alternate histories, I want to be able to talk about their clients about it, but I don't have to build it, is why we actually built that market hindsight tool on our website, is really to help them be able to show clients very quickly and easily that a third party, Vanguard, right, has shown the value of what they're doing. And then they could just model a few of the things that they had talked about and have the outputs without them having to try to rebuild it and recreate it in some way.
So that's a good segue to something you said earlier as well, and that is the use of technology, and how advisors can leverage technology, perhaps to illustrate, perhaps to get buy-in, to get pre-commitment is a phrase that you hear a lot. What can you tell us about the use of technology with regard to aiding and abetting Advisors Alpha?
I mean, I think one of the best things that advisors could think about is, in addition to kind of showing the different scenarios like we talked about, it's also using it to like scale and consider like outsourcing. Like technology has come so far, you could consider outsourcing some of the portfolio management, right? So instead of spending all this time trying to pick the next outperforming stock and security selection and market timing, right? Kind of, you can outsource maybe to model portfolios and spend more time on the coaching, right? Because what I'm describing takes time, right? So it takes more time and effort. So you need to free up time from somewhere. And for a large part of it, like portfolio construction, has been commoditized, right? Programs will now rebalance a portfolio for you. Programs will actually even do tax efficient drawdown, right? And it can take into account how you should think about Social Security or other types of things like that, right? So there's a lot of technology out there that can help you educate clients, can free up time, right? So advisors can spend the time where they really need to, is building those relationships with clients and building trust. Because the only way, right, that you can even possibly think that people would follow the coaching, right, is a track record of trust with advisors, right? Because they might be more comfortable if after 5 years or 10 years with you, had the global financial crisis happened, you could have said, hey, we've been through this before, right? And this is what we did, and this is how it worked out. But that takes time. So the most important asset an advisor has, the most valuable thing, is their time. So just make sure they spend their time on the highest value add, and then outsource or use technology for those other parts that maybe not be where they could add the most value.
The thing that's related to that is another thing that I've heard you say, which is to lead with service, so that when the advisor is working with a family and trying to integrate, perhaps doing passing the estate down to the next generation, or doing a tax integration with the corporation or what have you, those are the sorts of things that can hopefully do what you talked about a moment ago, the building of the trust. Any comments on leading with service?
Yes, I would say, kind of when we started, people expect more, right? So producing great investment performance or great investment outcomes is expected, right? But what's also expected is service. If a client calls you or reaches out or has a problem, right, service is equally critical, right? So I would say, service is extremely important. And if you think about it, it really is a form of business development, right? Because if you have a great product combined with great service, right, you're going to have happy clients. You're going to have clients who are more likely to meet their goals, right? Clients like that are more likely to stay with you. So you're going to increase retention, right? And they're also more likely to refer family and friends, which is what we have done in research. The highest place where advisors get new business is from referrals, right? So leading with service combined with, a great product, right, should help, really improve client outcomes, advisor outcomes, and practice outcomes. So it's really a win-win-win. It's one of the rare places where I would say in life that you could probably get that type of relationship.
That's a nice happy ending. So let's move on then to the way I always like to end, which is with that's bullshit, just happens. So we talked last week about some ideas. I'm putting you on the spot because any other guest, only does one show, but you're doing 2 shows back to back. So let's give us some time, Colleen. If there was a second thing that you could point to in the financial services industry that you're unhappy with, what would the other thing be that you're unhappy with?
I would say, I think it kind of goes back to behavioral coaching, where investors trail the returns that they earn of the funds they're invested in by 1% to 2%. And most people think it's because people are chasing performance or they're making irrational decisions, right? So the automatic negative judgment, whether it's investors or advisors, because as we talked about last time, right, it's all advised assets. So this is all invested assets. So we're looking at that. All the studies are saying 1% to 2%. So that means some advisors are doing it too, right? And I think what the shift needs to be is understand that people are applying the same decision-making framework that they applied in everyday decisions, where past performance, right, is highly indicative of what will happen in the future. Right? I don't think anyone buys anything anymore or goes to a restaurant without, checking the Amazon reviews or checking the Yelp reviews or Michelin star reviews, right? So using past performance as a guide for the future, right, is perfectly rational. So people are not necessarily being irrational. They're just applying a framework that doesn't work there. So instead, helping them understand that, educate them on the reasons why it's different. There's too many independent variables, and initial conditions matter, and they change a lot through time. So if you can educate them and then coach them through time, they'll produce better outcomes, right? But starting with everybody just performance chases kind of puts people on the defensive.
It's interesting because I couldn't agree more. We have prospectuses and other documents that the securities regulators require that we use for exchange traded funds, documenting emphatically that past performance may not be repeated and should not be relied upon. And I'm on X, and I know there are various experts that actively say that on every single post. They actually say that whenever they're posting with regard to performance, so as to be emphatically clear and to drive home the point that ought to be self-evident. What I guess now I'm going to have to ask you to, because you sort of already answered the shift happens part about what would you do. Maybe I can ask you to explain, if you could be so kind as to crystal ball as to how can we get people to disabuse themselves of the seemingly rational reliance on past performance when they make performance decisions and investment decisions with particular products going forward?
Yes, I think in some ways it goes back to technology. Show them examples of why it works. We have a paper, it was called Right Mindset, Wrong Market. So we actually provide examples of where it does work in life, and then numerous examples of where it doesn't work, right, with investing, and really actually educate them. So I think the most important thing is be empathetic, understand like, this is not crazy that you're, wanting to make decisions based on that. It doesn't work in investing. This is what's happened, right? When you put money in a 5-star fund from Morningstar, right, what necessarily happens in subsequent 1, 3, and 5 years, right, is equally likely to be a top performer or go out of business, right? So these are the types of things, if you educate people and just explain to them why, and you can use it through technology, right? So it could certainly just be an interactive video. It could be through on your website, just having something out there. But I think helping people understand, okay, I understand how to work here, and now I'm comfortable listening to what you have to say, right? So it starts out with, I'm comfortable with what you're saying to me makes sense. What's the better way forward, right? And how do I buy into the process?
Perfect. Colleen, thank you so much. I really enjoyed our conversation. I really enjoy your insights, and I want to thank you for the good work that you and the people at Vanguard do to help people understand capital markets that much better.
Yeah, happy to. I enjoyed it. Great to be with you.
Okay, so we're done. I promised to get you out at 4. My clock has it at 4:02. So I apologize for the 2-minute of overage, but
no worries.
I think it's fine. Now I'm going to have to stay on, because what I do my producers have said that what I have to do is I have to do a 30-minute promo. So after every episode has been taped, I do a 30-minute promo about what you're about to hear. You don't have to be here for that, so you can go. I'll just tape the promos on my own. Thank you. And the last thing, number that you just referenced about the right time, wrong market, or whatever it's called, I can't recall the exact name. Could I ask you to please send that to me?
Sure. Yep.
Okay. So it's been wonderful speaking with you, Colleen. It's been a pleasure working with Vanguard for years. I was in Malvern back in 2017. I got a chance to meet Mr. Bogle. I pestered my managing director for Vanguard Canada for 5 or 6 years to say, hey, I want to meet Mr. Bogle. And like, oh yeah. I said, okay, come on. Like, he was like 90 years old. It was like, come on, I don't have a lot of time. Yes. So we finally set it up. I got a chance. I presume you're actually in Malvern. I don't know, but
I am. Yes, I used to see Mr. Bogle frequently on campus. Yes.
Yeah. So great.
That's great.
Pleasure speaking with you, Colleen. And I hope we can be in touch. Thank you so much.
Yes. Thank you. Take care. I enjoyed it.
Right.
Bye-bye.
Bye.
John DeGuy is a portfolio manager with Design Securities in Toronto. He is the author of both Bullshift, How Optimism Bias Threatens Your Finances, and Stand Up to the Financial Services Industry, Protecting Yourself from Well-Intended but Oblivious Advisors. The books are available online and in bookstores everywhere. The opinions expressed on Bullshift and Shift Happens should not be construed as investment advice. You can reach John at jdeguy@designsecurities.ca or at 647-STAND-UP. That's 647-782-6387.